For those of you who don't know me, Steve Healy is my name. I'm a tax partner in our practice. This morning, you won't hear very much from me. I'll talk a little bit about the current kind of tax reform agenda, which is kind of sitting out there once again. But you will hear more from my colleagues, Belinda and Kristen and Sam, who will be sort of taking us through the key parts. Some really interesting developments in the international tax and transfer pricing space recently, with an external High Court decision that was handed down last week, which is not a win for the Commissioner, which is a good thing for the taxpayer. And Tristan will tell us more about that. Some interesting developments at the indirect tax front, and of course the general corporate tax front that Belinda will take us through as well. So that's what the agenda looks like. We'll spend a few minutes just on the tax reform side of things. Then Sam will come up and join us around indirect tax and indirect tax updates. Belinda on corporate tax, and then finally Tristan on the international tax side of things. So first of all, federal tax reform. To say it's a fairly well-trodden path is probably an understatement. A well-trodden, sodden path as well, probably. It's been happening for a very long time, since 1936, I guess. But in terms of the Australian income tax system and associated taxes. But in the last few years, so most of you will remember, I think, the Henry Review back in 2008. It was commissioned and it was delivered in 2010. We kind of wind back there. There was an impetus towards rent taxes, resource rent taxes. There was a recognition that we, as a country, rely far too heavily on income taxes, and there should be a reduction in the corporate tax rate at that time to 25%. And at the same time, looking at some of the regressive taxes in our system, such as stamp duty, and replacing stamp duties with a broader-based land tax, which is a more efficient and a more progressive tax. All really sensible things. At that time, no increase to the GST. And one of the things I think when one looks at the notion of tax reform in Australia, to kind of take GST off the agenda really makes it very difficult to achieve any real tax reform, but it is a sacred cow. It's also very difficult at a practical level, just because of the nature of our federation, because you've really got to have all of the states in alignment to get any real GST reform. But the general approach of the Henry Review was that there's an increasing mobility of labour and capital. Of course, that's only increased further in recent times as technologies have advanced, and particularly now we're in the age of AI. I think it becomes even more important that we go back and look at this. And so they identified a need to move away from reliance on mobile and inefficient taxes, company taxes and stamp duties, and towards more efficient and immobile taxes such as land tax and resource rents tax. After that, we saw in 2014 the Federation White Paper was commissioned, and also the Tax White Paper was commissioned. Joe Hockey in 2015 released that. Again, starting nothing off the table. Rethink was the name of the discussion paper. At the end of the day, it stalled and nothing ever happened with it. There was a note of at that time that GST, that base is being eroded due to exemptions. And there was a question as to whether broadening the base could improve efficiency and reduce reliance, but that's about all there was. So at that time, it did highlight challenges to the digital economy, the growing digital economy, and we'll remember the Netflix tax that was introduced sometime after that. Of course, in 2021, we had the pandemic. It seems like a distant memory now, but a pretty weird time in history. And of course, there were a whole lot of tax measures were announced and that were implemented to sort of keep us afloat. 2025, I guess fair to say there's a few economic challenges around the world, most notably coming from the United States, which is now a very, very unpredictable economy and has a very, very unpredictable government. And now that we've got the economic roundtable, which is happening as we speak, is the key theme. So yesterday it commenced. That was all around resilience, focusing on international trade, skills mobility and capital attraction. Today is about regulation, competition and AI innovation. And tomorrow is a really exciting one for tax people, because allegedly there's going to be some discussion about tax reform. And just so that we're all kind of in that picture, the proposals that have been put out there, the Grattan Institute has suggested replacing stamp duty with broad-based general property taxes, same kind of thing again, but, you know, I'm moving in the right direction. And then the more controversial ones around reducing superannuation tax concessions, reducing the CGT discount, winding back negative gearing, minimum tax on trust distributions, and broadening the base of GST, and or raise the rate. Yeah, big tick for that one, but good luck. See if that one gets through anywhere. And then, of course, the Productivity Commission. So you would have read recently there's talk of a net cash flow tax. So the reduction in the corporate rate, and then an incentive for companies operating in Australia to invest in capital, so that a deduction for capital expenditure outright as opposed to depreciation. But the corollary is this cash flow tax, which would be a 5% tax on all cash inflows, not accounting profits, although there's that immediate deduction of capital expenditure. So it'll be really interesting to see what, if anything, comes out of I think after the number of attempts we've had, I think we'll probably be having a similar conversation in another 12 months or 2 years' time. But anyway, that's enough from me. I'm going to ask Sam to join us, and he'll talk to us about some indirect taxes updates. Look, I'm maybe a lone voice, but I also support an increase in the GST for the next 20 years. So I've got a couple of topics, but I'll try to keep them reasonably short, given PepsiCo is probably going to take up a little bit more time than originally budgeted for when we set the agenda. Probably the first one, and this may affect a few people in the room, but maybe just for those who have heard of it, the ATO's supplementary annual GST return. Does that ring a bell for anybody? Yes. Right. What of sad faces. So this is not a new 13th BAS. This is not a return that's going to have a huge amount of numbers in it. What the ATO is looking to do, and for those that had the the displeasure of being in the top 100 or top 1000 program, the ATO spent a lot of the last 10 years investing in that, and it's effectively only funded, let's say, 4 years at a time. The ATO is starting to kind of unwind that because the amount of money they're making from that cohort is kind of winding down. They're now starting to focus more at the private group level. What they're looking to do with the top 100 and top 1000 is move more into more of a monitoring phase rather than an intense audit phase, which is what they've been in for the last, say, 10 years. And the way to do that is, so most of the top 1000, in fact, all of them should have been reviewed at least once, some of them 2, maybe 3 times. What the ATO is looking to do is to move more into a monitoring phase. So essentially all of the hard work in terms of putting in place tax policies and procedures, control testing programs, and all of those things should have already been up to a certain level now. If you're not, the ATO is probably still chasing you. But the ATO is now looking to say, look, we've kind of done the hard work. You've done the hard work. We're kind of just expecting you to maintain where you are, or ideally enhance or continue to enhance your tax governance and risk framework. So every year, for those who are affected, they will now be required to lodge an extra return. So it's not a BAS. It's not going to contain all of your transactional data. What it is it's going to contain 6 key elements that you have to essentially just a box that you fill in with a whole bunch of words which address these key points. So off the back of the last ATO review, the ATO is wanting to understand, well, what have you done to address the issues that were identified last time? So that's the first one. Second one is what things have you done to maintain or ideally enhanced your risk framework? The ATO is really pushing the GST analytical tool, for those who are unaware of it, so also known as the GAP. What that is, it's essentially a reconciliation between your reported numbers on your BAS, compare that against your financial statements, which sounds kind of easy enough. The way I look at it, it's almost like tax effect for GST. The problem is that those 2 sets of numbers don't start their life out at the same place. And so trying to actually do that reconciliation for particularly larger groups is actually quite a difficult exercise. A lot of time gets spent doing that. The ATO is putting a lot of emphasis on that, to the point that may well be one most highlighted thing out of these returns. They're probably going to look at that. They're probably going to look at how close you can get those numbers. The closer you are, the more kind of comfort they get from what you're reporting on BASIS. ATO for the first time is really looking to understand where you're taking, say, aggressive positions. They've deemed it material uncertain GST positions. So for those who do reportable tax positions, there are similarities between what is required to be reported here. So if you are taking a GST position that is uncertain, so the ATO draws a line at something that's 50-50 is deemed to be uncertain, and obviously anything below 50-50 definitely is uncertain according to the ATO. But even if you're taking a position that is inconsistent with an existing public ruling or is in line with a taxpayer alert, that's something they now are requesting taxpayers to report. Material, I think the categories are 250,000 and 500,000 depending on your respective turnover. So material uncertain GST positions need to be reported. And to the extent that you have any major GST errors, again, that level of materiality applies. If you've messed something up and you've had to fix it, you need to report in this return what you've messed up and how you sought to fix it, whether through a voluntary disclosure, whether through a BAS amendment. Ideally, you've done something. Otherwise, if you're reporting it here for the first time, probably not a good look. And again, for the first time, the ATO is wanting details of where you might have claimed a input tax credit in a period after you could have claimed it. So for input tax credits, you have a 4-year window. So yes, you might receive a tax invoice today, but you're actually not required by law to put it in current return. You have up to the next 4 years to do so. Various reasons, come up inbox, you don't know what the answer is, so you just kind of hold it off until you work it out. Various reasons why you might not claim it in the first month. The ATO is wanting to understand if you've deferred the claiming of a credit, whether you've done it, and you can explain why. So there are already entities that are in this reporting system. So for those who've already had a 100 or 1,000 review for 30 June 24, you would have been required to report this year. You can see the relevant reporting timeframes. But eventually, once everyone's had their latest assurance review, everyone in that top 100 and top 1,000 cohort will be required to lodge one of these returns. So that's that one. So moving on to payroll tax. This wasn't originally a case that I had envisaged, but circumstances changed, so we had to change tack a little bit. This is the appeal from the original Supreme Court decision in New South Wales for the Chief Commissioner of State Revenue against Uber. For those who paid attention the first time, the case is relatively straightforward in terms of the facts. I mean, everyone has a vague idea how Uber works. Essentially, the two apps, there's the rider app, which is probably what we all see. For those who might moonlight and have a second job, they might also have the driver app. And in that driver app, it makes clear in the terms and conditions that it's the driver who has the contract with the passenger. So when we hop in, we have a contract of transportation services with the driver. The ABN and the details of the trip will be of the driver. It's not Uber's details. And Uber makes clear that what they're providing is essentially a digital platform. They're not providing to us transportation services. So that's what the contractual framework looks like. What the case was about was the fact that the delivery of those services to the passenger might be from the driver, but there is effectively a deemed service which exists between Uber and a series of deemed services between the driver and Uber. And those deemed services were things like, look, fundamentally, Uber does not exist without the drivers providing the transportation services. So kind of substance over form, the court, and even in the original case said, look, Uber is providing a service of transportation. And that is the crux of Uber's business. They also provide a service of rating passengers, and they also provide a service of referring other drivers into Uber. They're the kind of three elements of the service that were being provided by the drivers to Uber. Really what the case hinged on was whether the payments, which, as you would be aware, Uber deducts the payments from our respective credit cards or bank accounts, goes into Uber, Uber deducts its fee, which might be 20 or 25%, and then remits the balance back to the driver's bank account. The physical flow of that money from Uber's bank account back to the driver is what was at issue, and whether that payment, I'll call it payment in a physical sense, it's just a flow of money, whether that flow of money was seen to be effectively remuneration for the services that the drivers were providing to Uber. Now, the original court went through all those things and said, yes, there's definitely a relevant contract here. There is a contract that exists between Uber and the driver. There is definitely a service that exists between the driver and Uber. But the physical payment that goes back from Uber to the driver is not seen as for or in relation to that work. It is simply, it's a collection of money as agents, more or less. And so therefore the Commissioner lost the first time around, Uber won. Great. Unfortunately, or fortunately, depends which side you're on, Chief Commissioner appealed, went to the Court of Appeal, 5 judges, same analysis, but the answer was different this time around. So what the Court of Appeal effectively said is, yes, we accept everything that the original court said, but as for the physical flow of money from Uber to the drivers, that is seen as a payment, physical flow of money, that's literally it. And there is a connection between that payment and the services that are being performed by drivers. So even though in a legal sense that money already belonged to the drivers, it's their money, it's their 80% or even though it's their money, doesn't matter. That is still seen as a payment for or in relation to the services that are being performed by the drivers. So that remittance of that 80% is now subject to payroll tax, at least according to the Appeal. And we're talking in New South Wales across I think it's the 5-year period of about $82 million payroll tax. And that's just in New South Wales. So you can extrapolate that across all of the other states, you get a sense of the dollars involved for Uber nationally, because other than Western Australia, these provisions exist, they're uniform laws. So same liability arguably exists in Queensland and Victoria, the rest of the states. So given the amounts involved, I think we're all expecting this to be appealed to the High Court, whether it be successful or not, who knows. The decision itself is consistent with the prior decisions that have been made with the Thomas and Nars, which we've spoken about before, or optical superstores, which kind of started this whole process. As much as the original decision that came out kind of conceptually made sense, that it was never Uber's money to start with, essentially the Court of Appeal has gone back to the earlier decisions and said, well, it actually doesn't matter whose money it is in a legal sense. What matters is the flow of the money and that there is underlying contractual service as between the two parties. So I guess we can wait and see as to what happens, but like I said, I expect this to at least be appealed. Last but not least, look, I'll be super quick on this one. For those who are unaware, most of the states impose various surcharges on foreign persons, both for stamp duty and land tax purposes. Predominantly it relates to residential land, but not always. In Queensland, additional land tax is payable on all types of land, so commercial property. What has been debated at length is the constitutionality of these surcharges. There are various double tax agreements that, as a non-income tax person, effectively say, look, you can't treat foreign parties different to how you might treat local citizens. Whereas obviously this imposes a higher burden on a foreign person buying a house, owning property, undertaking various transactions. A High Court case has been made by, I think it's a German company. They've been hit with Queensland surcharges, and I guess there's probably a reflection of the potential strength of that case that the Queensland government has implemented what they call a windfall tax, which more or less says that if the government loses that High Court decision, they will impose another tax, which is dollar for dollar the same number that you would have paid and you've been liable for the unconstitutional tax. So if the taxpayer wins, they still lose, according to this. Tax.
Thanks, Sam, and thank you everyone for coming in today. I'm going to run through the corporate updates and I'll also talk about some of the employment tax development. I just thought I'd start though with the ATO priorities release. So it set out what it's going to focus on, I guess, over the next 12 months. In the corporate space, the focus is still on international transactions, not surprisingly. The first one that they've provided, it's fairly niche and it relates to groups that operate through multiple entry consolidated group structures or MEC groups. Those structures provide opportunities to move assets to sort of a different holding structure and get them effectively out of the Australian tax net. So the ATO is going to start really zooming in on those and looking at them carefully. They did provide some guidance in Tax Alert 2020/4, which set out the concerns, but they're going to start drilling down on that further. IP arrangements obviously remain a focus, in particular around royalties being paid and where the income is generated in Australia but it's not being returned here. So Tristan's going to speak to the Pepsi decision, which is perhaps a blow to the Commissioner, but unlikely to deter him. A lot of the ATO's focus in this area has been around software, and the Pepsi decision probably doesn't help with that at all. The other one there is that the ATO has noticed an increase in private equity investment into Australia, which tends to be quite opaque. The higher up never provide the structures down. So the ATO has indicated they're going to really look at that now and start pushing to try and get some of those details so that they understand the risks to the revenue in Australia. The other point there is just the change to the top 500 program threshold. So this is the ATO's, I guess, program for assurance over the top private groups. It applies to, I guess, the largest taxpayers. They've increased those thresholds. So the net assets is now over 500 million. It was previously 250 million. So that's doubled. 200 million turnover threshold and 250 million net assets. So that 200 million has increased from 100 million previously. And then the final one is just sort of market leaders or groups of particular interest. Also up there on the slide is the focus areas for small business and individuals, noting the focus on registrations. They mentioned GST in particular, but also FBT. There's also the wider focus around debt recovery and lodgements as well. And we've certainly noticed a significant increase in the non-remission of interest, non-granting of extensions for lodgements. So they're really tightening up in that area. Next up, I'll go through the decision in SNA Group and the Commissioner, which was a win for the taxpayer, which was good, and another win for substance over form. So in this case, the taxpayer was a Queensland-based property group, and it had sort of a number of entities within its structure. And over time, the group had evolved so that each of those entities had a particular function within the group. Between 2015 and 2019, one of the operating entities in the group paid substantial service fees to another group entity for rent rolls, for branding and also for human capital. And the fees, they weren't well documented though. There was no formal contract around them. There was, I guess, an informal understanding. The ATO denied the deduction for the taxpayer, stating that there was insufficient documentation to prove the expenses were incurred, that there was insufficient commercial justification, and that the arrangements were designed to shift profits around the group. The court disagreed and they ruled in favour of the taxpayer, finding that the imperfect documentation didn't invalidate it and that they were still eligible for a deduction. They found that they were genuine services rendered and recharged, and that's enough to enable the deduction. The court also referred to precedent around the lack of formal documentation, noting that the evidence of the parties' conduct needs to be considered in order to draw inferences around what had been agreed. They found that in this case, there was such an agreement for these services. They found that the paying entity understood that they needed to pay the amount, and the providing service provider understood that they would receive payment for the services that they provided. The court, Justice Logan in this case, also noted the need for the Commissioner to take a more commercial approach to audits, which certainly the ATO is not well known for doing that. And I guess in terms of key takeaways, appropriate documentation is obviously best practice, but it's not going to invalidate a claim. And it's also one of, I guess, a few more recent decisions which have been around documentation, which the Commissioner has lost. He seems to hold a higher standard for documentation than the legislation actually requires. Okay, just a few employment tax updates. The first one is just some updated guidance around the calculation of electricity costs for employers who allow employees to charge electric vehicles at their home. It applies to both income tax and FBT purposes. So previously that guidance only applied to electric vehicles. So to the extent that employers are providing electric vehicles, that's certainly something to look at to make sure that you're getting the Commissioner's requirements. I've previously spoken about the AAT decision in BQKD against the Commissioner. So in that case, the initial tribunal decision, the tribunal found in favour of the taxpayer. As a recap, the taxpayer there was a trustee company of a trust, which carried on the business. So the trust itself carried on the business, and then there was the trustee company. The trustee company owned a number of luxury vehicles. I think there's around 40 in total. And the company allowed the directors of the company to use those vehicles and they didn't pay FBT on the use of those vehicles. At the first instance, the tribunal held that there was no employment relationship and therefore FBT didn't apply. In particular, the directors were not employees of the trust, and it also found that the benefits weren't in relation to employment. The Commissioner appealed the decision and has been successful. So the court held that the definition of employee for FBT purposes is wide and that it could include a director and in fact a director of a trustee company. In this particular case, the individuals performed a significant amount of work for the company and they did receive benefits in connection to it. I think they were paid superannuation contributions by the trust. The court, as said, the court found that the objective evidence indicated that they were employees for FBT purposes. Next up, just on the Toowoomba Regional Council case, which Steve spoke to at our last update. So the Commissioner has appealed that, and they have also released a decision impact statement saying that they will continue to apply their reasoning until they have exhausted the evidence process. So ignoring the current. And also just a reminder that as 30 June is now passed, which feels like a long time ago, all the ATO withholding tables have been updated. So the changes predominantly relate to indexation, no changes to marginal rates, so they're not big changes, but just to check those to the extent they're relevant to your role. Payday super, and the release of the exposure draft legislation. So a reminder that this takes effect from the 1st of July 2026. The exposure draft represents quite a notable change to the superannuation system. Maybe firstly, just in terms of what hasn't changed, So the earnings base remains largely the same, although it's now called qualifying earnings as opposed to ordinary retained earnings. And it also still includes the extension for superannuation purposes to contracts that are primarily for the provision of labour. There still remains in place a maximum contributions base, although that now applies on an annual basis as opposed to a quarterly basis. The key change, of course, is that employers are required to make the contribution to the fund within 7 days of the relevant earnings being paid. Obviously, at the moment, it's quarter end, 28 days after. Where the payment isn't made on time, then an individual shortfall amount will arise. So conceptually, that's sort of the same as the current system, although the mechanism for the calculation is a little bit different. In terms of the amount that's payable, it's split into 4 components. So it's got the individual shortfall amount, which, as I said, is essentially the super that you haven't paid. And you are able to reduce that for late contributions that are made. There is an individual notional earnings component. That's effectively that interest charge. So at the moment, it's 10%. That will apply, though, it will take into account late contributions now as well. So that will assist in the interest, reducing the interest payable. There is an administrative uplift. So at the moment, that's $20 per quarter per employee. So that's going to change to up to 60% of the shortfall amount. So that's a big increase on that. There are regulations that will allow the Commissioner to reduce that, but that is a substantial increase. Obviously, the elements make people pay the super on time, so quite onerous. There's also a 4th component, which is the choice loading, which applies if you're not paying the fund into the, not paying the amount into the employee's chosen fund. That's 25% penalty. There is a little bit more flexibility in terms of late payments. So, for example, the Commissioner can allow late payments for natural disasters and things like that. Where there is a shortfall from an administrative perspective, the SGC statements are no longer required. So that was that sort of Excel document that you filled out. That's no longer required. Now you need to do a voluntary disclosure to the ATO. Late payment penalties then also apply on top of the SGC amount itself. I think they ranged between 25 and 50%, where you don't pay the super, like pay the amount as soon as you lodge the statement, and there's also GIC on top of that. The one win is that you can now claim an income tax deduction for a late payment of super. So you can claim it for the super and for the SGC. You cannot claim it for the GIC though, or for any late payment penalties. So that's all coming 1 July 2026. And then just a quick other items to note before I hand over to Tristan. So the Commission has been granted special leave to appeal the decision in Bendel, which relates obviously to Div 7A and whether a UPE constitutes a loan. As with the Toowoomba decision, until the appeal process is finalised, the Commissioner will maintain his view that he's currently provided. There is also some further guidance around Div 7A in relation to what constitutes a valid repayment. The other one there to note is that for entities required to prepare a consolidated entity disclosure statement or a SED statement, so this is for public groups, you now need to disclose both Australian tax residency and if that your subsidiary is a dual resident, you need to also disclose the dual residency of the subsidiary. Previously, you only needed to say that they were or weren't an Australian tax resident. The ATO has also provided some updates to its guidance where you are saying one thing in your SEDS, but filing your returns on a different basis, they will no longer treat your arrangements as low risk. So obviously going to be some cross matching going on there. And that is it from me. I will hand over to Sid to talk about Pepsi and income. So thank you all.
Thanks, everyone. Yeah, there's certainly some common themes coming through in the indirect tax and corporate tax that I think are present in PepsiCo. So we'll go through those. This was a decision on appeal from the full federal court, which the commissioner lost, and they also lost, as Steve alluded to, in the High Court as well. For those that aren't aware of the background, I think it is worth just going through some of the facts, the relevant facts in the case. Very broadly involved two US resident companies within the PepsiCo group, PepsiCo Inc. And Stokely Van Camp, which we'll call SVC, and also the concentrate manufacturing company of Ireland, which was a relatively distributor. And these entities owned the intellectual property brand rights associated with a number of the PepsiCo brands, such as PepsiCo, Mountain Dew, Gatorade, and 7-Up. And these entities entered into two distinct exclusive bottling arrangements known as EBAs with Schweppes Australia Proprietary Limited, which we'll call SAPL. And this was an entity, a third-party entity that was owned by the Asahi Breweries Group. And the agreements allowed for SAPL to manufacture, bottle, package, sell and distribute PepsiCo branded products into the Australian market. And it was broadly accepted by all parties, including the courts, that the EBAs contained an implicit license from PepsiCo and SVC to exploit the intellectual property brand rights of the group in order for it to distribute the products in Australia. And without this implicit license, it couldn't have conducted the business that it did. Importantly, the EBAs provided a provision within the agreement that the concentrate required to manufacture the drinks were to be provided by PepsiCo or another member of the group, which PepsiCo had the right to nominate. So, pursuant to the EBAs, PepsiCo did in fact nominate a seller of the concentrate to SAPL to be able to bottle and package the relevant products. And this entity was known as PepsiCo Beverages Singapore, which was an Australian resident. There's a bit of a trend of entities that have particular names that are not resident in the country that you would expect them to be. And this seller was nominated to sell the concentrate directly to SAPL. It also purchased the concentrate that it distributed to SAPL from a related party based in Singapore, known as Concentrate Manufacturing Singapore. That's the diagram. Sorry, I'll just share that. So you've got the exclusive bottling agreements between SVC and PepsiCo, respectively, with Schweppes Australia. The concentrate is manufactured in Singapore, sold to PBS, which is then sold to Schweppes Australia. The concentrate was sold by PBS to SAPL with quite a small margin, and there was no contention throughout any of the courts that this was not an arm's length remuneration for the role that PBS played in distributing to SAPL. I think it's important as well to note that these agreements were quite complex arrangements, and the EBAs were quite complex in of themselves and required both parties, both PepsiCo and SAPL, to perform a number of intertwined rights and obligations in relation to the distribution. PepsiCo would bring the brand. It was responsible for marketing and promoting the brand products. And obviously, SAPL locally was responsible for manufacturing consistent with the standards and quality assurance that PepsiCo required for its products. And it also required it to build relationships with retailers and sellers. So it imposed a number of obligations on SAPL as a result. Despite the complex nature of the arrangements, the bottling process, as part of the evidence, was that this was a pretty simple process, despite the rigid quality assurance that had to go through with manufacturing the product. The evidence was that it was compared to baking a cake using store-bought cake mix. So a homogeneous product blended in specific proportions to taste, something like cola which the local manufacturer would add ingredients such as water and carbonate the product. So there were really three issues that the court had to consider. The first was whether or not there was an embedded royalty. And so for payments that Sapple made to PBS, whether or not that payment included, at least in part, a royalty for the right to use intellectual property that was licensed by PepsiCo. And if that payment did contain a royalty, or at least in part, did the US companies derive the income associated with that payment for the payment of the royalty? And the third question was really an alternative question. So to the extent that either the payment was not a royalty or the US companies were not deemed to have derived that income, were the US companies instead liable to pay diverted profits tax by way of entering into a scheme with the principal purpose of obtaining a tax benefit, and that being the shortfall of withholding tax that it should have otherwise paid. So, as alluded to, the Commissioner lost on all three questions in the High Court, which was on appeal from the Federal Court, which had also had lost on all three questions. And this had overturned the original Federal Court decision, which found in favour of the Commissioner on all three questions. I think it's, before sort of going through the reasons around each of the questions and the reasons for the decisions, I think it's important to just reflect on the actual decisions that were made by the court. Firstly, as you can see here, it was quite a tight case throughout. The Commissioner won in the first instance and then essentially split decisions in full Federal Court and High Court, which it just came out on top. So overall, 6-5 decision on what, as I'll go through, a pretty good set of facts and supports sort of commerciality of arrangements. So I think from my perspective, and I think this was alluded to before in Belinda's presentation, is that the Commissioner is probably going to be buoyed by the fact that it had quite a number of judges rule in its favour, and also the fact that this is quite a complex case with very specific facts. I think will encourage the Commissioner to continue to apply his reasoning on things like software arrangements and the like, which you're not as easily able to separate physical product from the licensing of intellectual property. So on the embedded royalty decision, so the question was, did the payments made by Sapple to PBS include at least in part a royalty as consideration for the right to use intellectual property? So there was no question, as I alluded to before, that there was an implicit licence by PepsiCo to Sapple to be able to manufacture and distribute the PepsiCo branded drinks, because without it, it couldn't have done so. And the argument the Commissioner sought to make was that, well, if you need the brand to be able to manufacture and sell the drinks, then if you haven't paid a royalty for that, then you've essentially received that for free. And the corollary to that is that PepsiCo's given it away for nothing, which to the Commissioner's reasoning was just for a brand as valuable, a global brand as valuable as Pepsi. However, the court disagreed with this reasoning and argument and said that the agreements, the EBAs, were, firstly, they weren't, and this comes down to the derivation question as well, they weren't for the sale of concentrate, but rather they were promises made for either for PepsiCo to sell concentrate or to nominate another party to sell the concentrate. And that in any case, the agreements, the EBAs themselves, actually place quite a number of obligations on Sapple as the manufacturer, bottler and distributor to be able to conduct its activity, and that those agreements were mutually beneficial to both parties. The consideration that PepsiCo received for the right, for the licensing of that intellectual property were the obligations that were performed by Sapple, rather than the payments that they made for concentrate to PBS. So you've got the sale of the concentrate. Probably helpful to go back to the diagram. So these agreements here were directly for the payment of concentrate, and that these exclusive bottling arrangements, or EBAs, were consideration for the licensing of the intellectual property that was received. And that's a really important point, and I think actually takes some logic out of the case Sam was talking about in terms of flow of funds and what payments are actually for. So just reiterating, the price, the contractual price paid by Sapple to PBS was for concentrate only, for those prices for the goods to be sold and delivered. Because there was no dispute that that price was an arm's length price by any of the parties, there was no additional consideration that could have been deemed to be a payment for royalty. So if the price of the products is arm's length and what you would ordinarily pay for the products, then there's no additional amount that can be attributed to a royalty for the right to use brand or IP. So on the question of derivation, the Commissioner sought to argue that because PepsiCo had the ability under the EBAs to nominate a seller, it also had other rights, such as the right to terminate the contract if any of the sort of obligations by Sapple weren't met. There was also a specific clause within the contract that enabled PepsiCo, or well, rather not PepsiCo, but provided for additional interest on any late payments that Sapple might make, but didn't nominate a particular entity that those amounts were to be paid to. And the Commissioner argued that in the absence of defining those, defining an entity, that those payments would have been paid to PepsiCo. And the argument in substance was that the payments that were made by Sapple to PBS were constructively paid to PepsiCo, and that they did derive that income. So the majority in the court accepted that you can have a constructive payment, so a direction by a creditor to a debtor to pay a third party is deemed to be a payment to the creditor. But it was held that there can be no payment by direction unless there is an antecedent monetary obligation. And in this case, there wasn't. As I said before, the EBAs were agreements for promises for concentrate to be sold in the future. They weren't agreements of the sale of concentrate itself. Those were subsequently entered into directly with Sapple and PBS. And therefore, there was no monetary obligation owed by Sapple to PepsiCo, and therefore PepsiCo did not derive the income that was paid by Sapple to PBS. So hence the Commissioner lost on that question. So the diverted profits tax question is really an alternative argument that the Commissioner sought to make, which is if either the payment didn't constitute a royalty or that PepsiCo did not derive the income that was paid by Sapple to PBS, that diverted profits tax applied. And these are anti-avoidance provisions that apply at a penalty rate of 40%. And essentially applied, the Commissioner argued at least, that they applied because PepsiCo would have otherwise been subject to royalty withholding tax on the payment. The other argument that I guess one of the statutory requirements is that you've entered the scheme for the principal purpose of obtaining that tax benefit. And this is one where previously we didn't have any judicial precedents on, so it's good that we do now have some judicial precedents on diverted profits tax. So without going into too much detail in relation to the diverted profits tax provisions, there's really two key aspects that I really want to sort of touch on in terms of this case. Firstly is the question of whether or not there's a tax benefit. So you do need to have a tax benefit for DPT to apply. And as I said, you also need to have entered into that scheme for the principal purpose of obtaining said tax benefit. So, and I think in respect of a tax benefit, it's worth noting that the onus and burden of proof rests on the taxpayer to prove that there is no tax benefit. And the Commissioner, because it had lost in the full federal court on the basis that PepsiCo had successfully argued that the alternative postulates put forward by the Commissioner were unreasonable and won on that basis. The Commissioner sought to argue in the High Court that that wasn't sufficient to meet the burden of proof in determining whether or not a tax benefit had been obtained. PepsiCo argued that there was no alternative reasonable postulate, so there was no alternative to the transaction that it did enter into, which would give effect to the same commercial outcomes. And the Commissioner contended that this was insufficient, that PepsiCo not only had to prove that the Commissioner's arguments were unreasonable, it was insufficient for them to say that there was no alternative postulate. PepsiCo, at least the Commissioner argued, had to identify an alternative transaction to the one they actually entered into, for which withholding tax did not arise. And the full federal court rejected this idea, and the High Court agreed with this decision as well. And when I think about it logically, it's very difficult to prove that something doesn't exist, right? Just as a basic premise. So PepsiCo did a pretty good job in proving that there is absolutely no alternative that they could have, no alternative transaction they could have entered into which would give rise to withholding tax. So to say that they can't meet the burden of proof unless they put forward an alternative postulate that doesn't exist, I think shifts the burden of proof in such a way that makes it impossible, and I think is, just a real sort of failure in logic, really, by the Commissioner. But I think it was a sort of a Hail Mary pass, I think, that they tried to make on this one. So, anyway, thankfully the court agreed with that. So notwithstanding that there was no tax benefit, so there was really no requirement for the court to consider the principal purpose test. But they did provide some observations in any case, and they really hammered home the points that I've already kind of spoken on, which was firstly the payments to PBS by SAPL were just for the concentrate. There was no other component. The dealings were at arm's length. They were between unrelated parties. You've got PepsiCo engaging with an independent bottler owned by Asahi Breweries, and the dealings are priced at arm's length, and there was no contentions that the pricing was at arm's length. And I think more interestingly, and I think this actually was a very relevant fact to the outcome of the case, was this franchised-owned bottling operation model where brands would approach independent bottlers with manufacturing facilities to produce the products were essentially in place since the early 1900s. I've got 1990s there. That should be 1900s. So, these arrangements are hundreds of years old. And I think one of the arguments that PepsiCo made was that the commercial arrangements that it has in place to contract with independent bottlers were around before withholding tax even existed. So the idea that it could have entered into this arrangement with the principal purpose of avoiding withholding tax didn't make any sense. The exact EBAs that were entered into obviously were agreed after the introduction of withholding tax, so 2009, but notwithstanding the commercial arrangement, which was the EBAs were based around, have been in place for over 100 years. And again, required specific contributions by each of the parties in terms of their responsibilities and sort of relative competitive advantages. And this model was very, very carefully reflected in those EBAs as I've articulated. So I think the key takeaways is, well, it's good that we've got judicial precedents on the application of diverted profits tax. We've also got confirmation around the concepts around payments for consideration. But I think given the specific nature of facts in the case, as well as the fact that it was such a close decision, and the Commissioner's focus really has been around software arrangements, I don't think this decision will deter him in any way of continue to pursue the lines of arguments that he has in the draft tax ruling 2024 D1 on those distribution arrangements. So I just want to spend just a little bit of time on the ATO's guidance that was released recently on determining the arm's length amount of debt. So this PCG is in response to the change in the thin capitalisation rules, which go from an asset-based regime to an earnings-based regime. So interest deductions limited on the basis of earnings rather than assets. There was a specific provision in Australia's transfer pricing rules, 8.5140, which essentially deferred to thin cap. So you determined the arm's length interest rate and then you applied that to the debt amount that was actually issued rather than the amount of debt that would have been issued if the arm's length conditions had operated. That provision broadly has been removed for most taxpayers. And so there's now a requirement to determine not only what an arm's length interest rate is, but also what an arm's length amount of debt is. And helpfully we have 4 colourful zones, white, green, blue and red. And most taxpayers will fall into the blue zone. And the reason for that is there's 5 examples, so 2 low risk and 3 high risk. And essentially, you fall into the green zone if you fall into one of the very narrow, specific green zone examples, and you don't fall into one of the red zone examples. And if none of the very simple examples that are provided match your facts, you fall into the blue zone. So probably most taxpayers will fall into that blue zone. But it is helpful. The guidance is helpful. It goes through the kinds of factors that you would go about considering when obtaining external financing. So you'd consider your options realistically available. You'd look at whether you had sufficient internally generated capital to fund whatever you're looking to fund, whether you use debt capital or equity capital, and goes through a number of different kind of factors that independent parties would consider when obtaining financing, which for mine is relatively uncontroversial. And when we've done work around previously the arm's length debt test, which was under the old thin cap rules, these are the kinds of considerations that we would have, in determining what an arm's length amount of debt is. But it is good to have some guidance on that. Like I said, the examples aren't particularly helpful, particularly example 1. So if you apply the third-party debt test and all of your related party debt deductions are denied, the Commissioner thinks that's pretty low risk, which I tend to agree with. The Australian borrower has both leverage and interest coverage ratios that are equal to or better than its global group and comparable entities. So that's also very helpful if you can actually work out those ratios. And then some very unusual high-risk scenarios. So essentially a group holding significant cash reserves to have funded whatever it was they needed to fund, and they still borrow interest-bearing debt. An example where an entity obtains an explicit guarantee with the specified purpose of obtaining a higher amount of debt than it otherwise would have. So literally an anti-avoidance scenario. And then a peculiar scenario around obtaining cross-border financing and then on lending it for the purposes of sort of gaming the fixed ratio test outcome. So very, very strange. It's in draft at least, so hopefully we get some better examples on the final version, but probably another illustration of the ATO probably being a little bit devoid from commercial reality, I think, when they put these together. I know Belinda said maybe the documentation, maybe the standard that the Commissioner is putting forward for documentation might not be as high as the courts, but I think it's still important that if you do have arm's length, related party debt arrangements, that there is some sort of documentation put together to determine how you sort of arrived at that outcome, and at least the Commissioner, as you can see, is going to challenge it if you don't. And I think it's really key around sort of benchmarking, serviceability and leverage ratios. as well as just demonstrating other kind of documentation and evidence that you may have, such as group proceeds or details around the purpose of the funding. So I know we're on time, so only two other quick updates, which is the registration process for public CBC reporting parent entities is open, and the ATO have also issued some guidance around examples in which they'll provide an exemption, which for those who haven't read it, are fairly limited, as you might expect. Finally, so there's been obviously some global developments on Pillar 2. The US introduced a bunch of retaliatory taxes contained in President Trump's one big beautiful budget, specifically within Section 899. And there was a statement issued by the G7, I think it was last month, maybe it's a month before now, that they're essentially going to carve out US parented entities from the application of Pillar 2. What that means for Australian subsidiaries, well, if you're still in scope, you'll still have to complete a domestic minimum tax return. There's still eligibility for safe harbours, particularly in other jurisdictions, and you will still have lodgement obligations, and penalties will apply for failing to lodge. So that's it from me.
So takes us pretty much up to the wire. That's perfect, Tristan. 10 seconds left for questions. We don't have so many questions for any of our speakers. Now is the time. Never a dull moment in tax, which is why we can do these every quarter, because there's always going to be plenty of stuff to pull the agenda. But anyone have any questions for anyone at all? I'll take that as a no. So thank you again for coming along this morning. It's a cold and wet morning, and I think that's kept a number of people away. But for those of you who made it here along, appreciate you coming along, and look forward to you seeing these smiling faces again. Probably another. Have a good day, and we'll see you all soon. Yeah.